Hey guys, and welcome to this week's episode of my portfolio. In the previous week, we pretty much went through a rough breakdown of my portfolio now, how it's been, because it's been a couple of weeks since I did the previous episode, and just a breakthrough of how my stocks are performing. So in this episode, we're going to focus mainly on talking through two stocks, and that will be Total and Shell, and we'll be buying some stocks at the end of the episode. Now, we're going to buy 4 stocks for the end of the episode, and once we talk through Shell and Total, we'll talk through why we're going to purchase these 4, and we're going to try and keep going with purchasing stocks on a more regular basis now, just to make sure we do price into the market at an average price by just buying consistently. So we'll get started in talking through these companies, and we'll go from there. So, both Royal Dutch Shell and Total are energy companies. They get most of their energy from oil and produce various oil products and materials. And the reason I got invested in these two companies to start with was due to the reason they're mainly very big dividend paying companies. Now, with lots of the oil companies, you do find they do pay high dividends because they are seen as risky companies. Oil is very volatile in terms of its price, and it can be very high and very low. And as we see by the past year, it was majorly hampered by the pandemic. Now, the pandemic caused major spikes in oil and a major decline as well, to a point where oil was actually profitable to buy in store, because people and refineries just weren't taking the oil, or they didn't shift what they needed to be able to take the oil into the refineries. So oil really did tank last year. Now, ever since the economy started to open again and businesses are starting to move, oil has somewhat picked up, and these two companies have started to increase and perform how they used to. Now, in terms of Shell, they did slash their dividend this year. It was sort of in the 8% mark to start with, but now it's 3.5, which is still a good dividend and probably one of the highest we've got in the portfolio, but it can go higher. And hopefully once the sort of economy sort of really starts to pick up and all the impact from the coronavirus has ended, they will bring back to the regular dividend, and Dutch Shell can really start to pick up back to where it was before. As you can see, where we were before the whole pandemic happened, there's still quite a long way of growth for the brand, and there's a lot more it can still get. But I do think it's going to be a very slow building one. It's not going to be quick by any means. I think a lot of the economy is still working from home and things have been hampered. But with the way we're sort of living now, with a lot of delivery, a lot of haulage and a lot of e-commerce, that there's always demand for fuel and always demand for energy. So it will always be something where these two companies will be used, and it's always a consumer product at the end, which I think is one of the important things for a company nowadays. It needs to be a consumer product at the end to keep it sustainable. And in terms of energy and the various products they produce, I think it will keep them going for a long time. Now, the thing with oil at the minute is there's always a push for greener products and greener energy. And Royal Dutch Shell, along with Total, have both sort of signalled that they want to be at that point where they are sort of pushing for more greener, renewable sources of energy. So because of that, it also helps sort of give you a sense of their planning for the future. And hopefully they will be able to keep up with the increasing repetition of newer products and newer technology, just to make sure that they're in the market at the time. So this is the website Seeking Alpha. Now what this can do is basically give you a breakdown of a company in terms of revenues, profit, income, and as well as the PE ratio for a dividend. Now the ratio for a dividend is how much of the dividends they're paying out compared to what they're having as an income. And the higher a PE ratio is, the more risky it is. And if a PE ratio is over 100%, the company is actually paying out more than it's actually earning. So that is always a red flag as well. The smaller the PE ratio, the better the company is positioned wise, and better it is to sort of be a more sustainable product. So when I look at these financial values, there's only a couple I really look at. One is gross profit, which, as we can see, even though we did have a hamper with the coronavirus, we did have a gross profit. Now, that is not everything, and you always do need to check the next one, which is the net income. Now, we did see that due to the coronavirus, that Shell didn't make a profit last year, or a net income. And that would, in my opinion, judging how they performed in the previous years, that is down to the impact of the coronavirus. And because of that, and people not traveling and business being halted, that's had a major impact in these oil companies. And with us starting to pick back up and hopefully go back to normal, I'm hoping we can push through and back up to where we used to be beforehand, where these companies were making more money. As you can see in the previous 4 years as well, they have made profit. 2019 was a bit of a decline from 2018, but the only way is up from where we are. And as long as with the gross profit as well, that was very good for the previous 4 years. So it does give me a bit of confidence with Shell, especially as well. The other thing to just check as well is the payout ratio, and it's 40%, which is it's good. I mean, there's a lot worse companies which are sort of in the 80% mark, which I would worry about. But 40%, it is a bit, but is it sustainable? Yes. And there has been a lot of news recently about many oil companies as well. In the Wall Street Journal, ExxonMobil and Chevron, two very big oil-based companies in the USA. Although they had a very, very difficult year last year, they have reported that their first quarter earnings for this year have been a lot better, and they are also in the green. So it's showing that the oil companies have got sort of a light at the end of the tunnel, and they are moving forward, which I'm hoping, if it's starting to show that way in America, hopefully it will travel over to Europe where these two companies are based, and it can signal better things to come. So Total, similar to Royal Shell, is pretty much in the same product. It's a competitor to Shell, and again, it's in energy and fuel and things like bitumen as well. Now, that's the reason really I invested in both these two companies. I work in the construction industry, and these two are very much at the forefront of bitumen supplies and various materials that need in construction. Now, similar to Shell, Total did do very well in the previous 5 years, and in terms of the gross profit, although it was a decrease in 2020, it did make a profit gross-wise. And then this is why it's always important looking at net income as well. It did have a decrease, but the 4 years previous were very good, although it was a bit stagnant in 2019, but we saw that in Shell as well. But Total does seem to be a bit better in terms of that as well. In Trading 212 as well, you are able to view the dividend, and for Total, I believe it's about 7%, 7.1% dividend, which is a really good dividend. You won't find many companies better than that without having a significant risk involved, such as your REITs and everything like that. But yeah, those are the two oil companies that I invest in, and the reason I invested in both of them is because I think there's some value in them. I think at the minute, they're very underpriced for what they are capable of, especially Shell. Previous price it was before the whole pandemic really shows that there is a chance to sort of invest while we're at the low point and continue forward as well. They're both planning for the future in terms of green technology, and I really think it will be something good for the future. But those are the two oil companies anyway. We're not going to invest in them this week because they are sort of trending downwards, which is a bit of a theme in my portfolio, but I do think we can pick them up a little bit later. There's 4 other companies which I think are more beneficial at the minute for us to invest in, and we don't have the biggest share in our portfolio either. So I'm just going to go through them, and then we'll talk through why we're investing, and we'll go from there. So first one is Microsoft, and that is because it is Microsoft. Now, is it a boring company? Yes. Is it one of the forerunners along with Apple and Amazon for the future? Absolutely. Now, it doesn't have a big dividend, but it's always grown a dividend year by year. And the sheer amount of growth and the new products is pushing towards a subscription-based sort of model as well. I think it's only going to improve in the future. And although it's priced quite high at the minute, it's the highest it's ever been, I do think it'll continue growing. I think these fintech companies have proven that there's always continuous growth. They've not hit the wall yet, and the profits they're producing annually as well is just breaking records all the time. And I can't see that changing for the foreseeable. So because of that, we're going to buy in. We've already bought some Microsoft already earlier in the year at quite a low price. So by buying at this higher end, we're just going to average it out anyway. So we'll pick up a total of £100 of Microsoft. I'm going to go for £400 this week because I've missed a couple of weeks and I just wanted to bring that portfolio base up. I don't like having as much money in the bank as I've got at the minute. So if I've ever got a chance to put some into my portfolio, I will do, just because it's given a better chance for my wealth to grow and just to increase my wealth more. In the minute in the bank account, it's 0.01 interest, and it's just not good enough. Whereas at least in my portfolio, my money's got a chance to work for me, providing I pick well, which hopefully from now on we will be. But yeah, going to pick that Microsoft up, and we'll move on to the next company. So 0.6 shares of Microsoft, that's just over £100, so we'll get that in. And the next company which we're looking to buy, Home Depot. There's quite a few of these American consumer companies where I've got a little bit in. in terms of shares, and I really want to start to pick that up. So Home Depot is basically just there for all forms of sort of DIY and stuff like that. It's continuous, it's a consumer product, and it's a very well-respected brand in America. I think that can only grow more, and it's one of those which is a consistent dividend as well. So we'll pick that up as well. And the third company which we are going to do this week will be United Health Group, which is a very good dividend company. It's in the health sector. It's a very sort of safe company as well. Nothing really happens there. It just sort of churns and just makes money. So we'll go for 0.4 there. And by doing this, we're sort of spreading out our wealth between all these companies. There's certain companies which had a lot more in terms of a share than others, and we just want to sort of split that just to provide some form of diversity. Disney really is sort of high at the minute, but we have bought quite low. But I just want to increase our share capacity with this. I think more Disney will really start to pick up when people like to visit the parks again. Disney's done a very good job the past year of really sort of broadening out the streaming service, so they're not so reliant on the parks anymore. And because of that, they're in a position where the parks is just on top of what we're already doing, and they're already doing such a good job at the minute. So that's the end of this week's episode. We've picked up 4 really, really good companies. I think we've bought really, really well this week. And hopefully next week we can have a bit of an update on the performance of that we're doing. Just as a brief overview, all the sort of stocks we talked about last week, pretty much the same. BlackBerry had a little bit of a run this week where it was looking as if we were going to go and pick up, but it's sort of flatlined again to where we are. Hopefully over the next sort of year or so, we can get that over to where we've bought, and depending on what sort of position it's in by then, we can decide if we want to hold or sell. But in terms of the portfolio this week, pretty much where we were. It was looking a bit rough sort of midweek, but we're doing okay. So we're just building out the rest of our companies. At the minute, we're still sort of top heavy with a couple of companies. So all we're doing now is just these sorts of companies below, just sort of filling them out so it makes supply a bit more diverse. But no, that's pretty much been this week. We'll be back next week, hopefully with another episode. Hope you've enjoyed. If you've got any comments, please leave them in the comment section. And like I did last week, I had a comment about the Total and Shell and why I bought them, and I sort of made a video about it. So we're going to do a video next week regarding crypto and other investments which I do, and we'll talk through that as well. But I hope you enjoyed, and if you do, please subscribe, and we'll see you in the next episode.